All right, so this presentation is provided and prepared by BlackRock. They're an investment company, and it's called Securing Your Retirement, Transforming Social Security into a Winning Retirement Strategy. But before we go into that, a little bit about me, your presenter. My name is Matt Ragudo. I'm a Chartered Retirement Planning Counselor, and I hold my certificate for long-term care planning. My passion is creating strategies that guide my clients to their ideal retirement, and I look forward to working with you. But for the sake of this video, just know that I hope to give you as much as you need as far as what financial planners and financial advisors have to guide you so you can make those decisions on your own. One more slide about myself and I promise we'll get into it, okay? Just so you can kind of get to know me a little bit, so I'm more of a human than I am kind of a presenter, this faceless person on YouTube behind a slideshow. This is my wife. This is us in Austin late last year. I enjoy watching tennis. I used to enjoy playing, but life gets kind of in the way of all that stuff. Plus the weather has been really strange here in Central Texas. But fortunately, my hobbies now include stock technical analysis, trading risk and volatility. I trade futures, derivatives, wheat, corn, oil, all that fun stuff. And that's just a little bit about me. Now on to the Social Security meat and potatoes of the seminar. All right, so now to the presentation. I'm sure many of you are aware that medical advances and healthier lifestyles have increased longevity. A couple who reaches 65 has a 50% chance of living to their early 90s and a 25% chance of living into their late 90s. However, people are not taking longevity into account when taking their benefits. Well, 66% of people collecting Social Security actually are collecting a reduced benefit, and many of them start as early as 62. So why, in the face of longevity, do many people collect benefits when they hit 62? Probably because they can. Even though so many people are concerned with longevity, they are willing to accept reduced benefits for life to avoid not getting their quote-unquote fair share of benefits because they may die early. But in reality, at the end of 2020, there are nearly 2.2 million people over the age of 90 collecting Social Security benefits. There were 69,571 people over the age of 100. So let's take a look at how Social Security kind of does their calculation. Now, most workers pay into the program with each paycheck and will qualify for Social Security benefits at retirement. Many workers pay FICA tax up to the Social Security wage base, which is $147,000 in 2022, towards Social Security. This amount is then matched by the worker's employer. To be fully insured, a worker needs 40 credits. A maximum of 4 credits can be earned per year. For 2022, 1 credit is earned for every $1,510 of wages. Currently, individuals who are paying FICA taxes are at least 60 should be receiving a Social Security benefit in the mail about 3 months before their birthday. The statement includes earnings record on page 2. You should check carefully because benefits will be based off this record, mistakes and all. If you spot any mistakes, call the Social Security Administration to correct them. Anyone under the age of 60 can only review their Social Security statement online by visiting www.ssa.gov. So benefits are based on the best 35 years of work, and that's here. And the benefits reflected on the statement reflect the assumption that you will continue to earn your current salary from the last 2 years until you begin to collect benefits. You should review the information on page 1, and this is where you'll find the monthly benefit estimate right here, depending on the age in which you begin collecting, right here. The Social Security Administration has a calculator on their website which will allow you to modify the expected retirement date and wage assumption to create a more accurate estimate of expected benefits. The maximum Social Security benefit for a worker who achieves full retirement age, FRA, in 2022 is $3,345. All right, let's go to the next page. So here are the trade-offs for individual benefits. For a single person, you have the option of collecting benefits anytime between the age 62 and 70. However, if you collect before the full retirement age here, depending on when you were born, you will be penalized. And of course, if you wait till 70, you will have an increased benefit. Full retirement age, again, is not the same for everyone. For those born before 1937, it is 65. For those approaching retirement right now, it is around 66. And for those who are, like myself, born after 1960, our full retirement age is 67. Now, in between those ages, or in between 1943 to 1954, it does change. So please check on your exact birth date on the Social Security website. Now, the cost of collecting earlier. As we saw, the majority of individuals take benefits before full retirement age. If you elect to take benefits early, benefits will be permanently reduced. The payment is not adjusted when you reach your full retirement age. And what else should you consider before you go ahead and agree to permanently reduced benefits? Percentage of monthly reduction and total reductions are approximate due to rounding. Actual reductions are 0.05% per month, or 0.555 for the first 3 years, and 0.05%, or 0.416 for subsequent months. So, considerations for collecting early. Among other things, you need to consider current health, family history of longevity, and if you are married, the age difference between you and your spouse. One extremely important consideration that could directly influence you not to collect early is whether or not you are actually retiring. Are you grabbing the benefits because you can, or are you grabbing the benefit because you're actually retiring and need the income? So if you continue to work and collect earlier, you must repay some of the benefits if you earn over a certain amount. Social Security benefits are intended to be supplemental retirement income, not wage replacement. So the Social Security Administration really wants you to be retired when you collect them. Therefore, they will penalize you for collecting early if you're not actually retired. If you collect benefits early, you will be subject to an annual earnings test, which looks exclusively at salary. Prior to your full retirement age, if you earn more than the threshold amount, which is, in 2022, $19,560 a year, you lose one benefit, or $1 of benefit, for every $2 earned above the threshold. Now keep in mind, this is on top of already reduced benefits. For the year in which you reach full retirement, the different rule is applied. The threshold is $51,960 in 2022, and the rule is that you lose $1 in benefit for every $3 over the threshold. And once you reach your full retirement age, there is no income limit. If you decide to change your mind after applying for benefits because you went to work, or maybe you made a mistake, you can have a do-over. The do-over provision is allowed only if the application is withdrawn within the first 12 months after starting benefits. Then the worker can repay benefits and essentially start over. The unlimited do-over provision was prohibited by SSA several years ago, the Social Security Administration. So remember now, the do-over can only happen within the first 12 months of starting the benefits. It can only be done typically once. When a withdrawal application is requested, benefits payments will stop and an individual can reapply when they are ready to file again without any reductions due to filing previously. They need to repay the Social Security Administration everything they had received to date, along with any family benefits paid on their work history, and then they can subsequently apply as if it were their first time applying. Now remember, the Social Security Administration only allows you to do this once per life. If you do wait beyond your full retirement age, you are provided a fixed income benefit increase. And as you can see in this bar graph, it's 8% per year, assuming you were born in 1943 or later. If deferred beyond full retirement age up to age 70, for someone with a full retirement age of 67, this could be a 24% increase by age 70. And for someone who has a full retirement age of 66, this could be an increase of 32%. So for those of you who are retiring soon, full retirement age of 66, you actually are able to get a bigger bump than people who are in my age category. Now here's the fun part, the break-even analysis. This is the part everyone kind of wants to talk about, figure out when or how long they have to live before they break even. So, how long do you think you'll live? It's a quite interesting question. So, whether you start receiving lower benefits early or waiting and collecting a higher benefit amount, at some point we can calculate a break even, which means you receive the same amount of money no matter when you started collecting. Take an example. If you start at age 62 versus collecting at full retirement, in this example, the break-even point is 78 and 6 months, right here. So after this point, waiting until your full retirement age, you would outpace the red bar, which is the 70%, the penalty or the early retirement income amount. Okay, and in the second example, the break-even when taking your full retirement age versus age 70 is 82 and 6 months. So if you think you're going to live beyond the age of 82 and a half, you should wait until 70, because at that point, your 70 age of benefit will outpace both the full retirement age of 67 and of course the lowered amount at 70% at age 62. While it's impossible to know exactly how long you will live, you can make a reasonable guess about your current health and family history and looking at your break-even age to help you when you are making this collection decision. Now let's talk about the taxation of Social Security benefits. So you may have to pay taxes on your Social Security retirement benefits if your provisional income, which is 1/2 of your Social Security benefits, plus your modified adjusted gross income is below $25,000 for single folks and $32,000 if you're married. All your benefits are tax-free. If it's above these amounts but below $34,000 for single and $44,000 for married, your benefits could be taxable between 0 to 50%. So what that means is not 50% tax rate, but 50% of the benefits are taxable. If you are single and you make over $34,000, married making over $44,000, your benefits could be taxable anywhere between 7 and 85%. If any of your benefits are taxable, you add that amount onto your taxable income for that year and are taxed at your appropriate marginal income tax rate. You can download your statement from Social Security Government, meet with a financial professional to review a personalized analysis, and incorporate that into your retirement plan. Now, for those of you who are watching this and want to do it yourself, you can go ahead and make some assessments based on the strategies we went through today. Make your kind of assessment on how you are going to make that or build this into your retirement plan. Now, how to file for benefits. There are 3 ways: online, in person, or you can call Social Security. Now, important note, this material is provided for educational purposes only, and it does not constitute investment advice, as we did not talk about any kind of investments here. The information contained herein is based on current tax laws, which may change in the future. BlackRock or myself, Matthew Ragudo, cannot be held responsible for any direct or incidental loss resulting from applying any of the information provided in this publication or any source mentioned. The information provided in these materials does not constitute legal, tax, or accounting advice. Please consult with a qualified professional for this type of advice.